Welcome back to Lem's Cryptoverse. I wasn't too happy with the last version of the sentiment indicator that I came out with, so I'm re-recording this, but an abbreviated version and with a new stereo mic. So let's hope this sounds better. So this is an abbreviated version. If you want to hear the long version with the evolution of every upturn and downturn, you can listen to the previous version of this. But this is going to be a quicker version so that I don't bore you, and so you could just get the gist of it. So let's get started. And number one, there are different ways of reading sentiment, and you can read this on your own. But there are some. I'll go over some of the ones that everyone knows about, like the CNN Fear Greed Index, and there's the crypto version of that, and there's internet search trends, and then there's the put to call data, options data, and data on futures. But that some people don't know about. But what I want to talk to you today is what's called proprietary indicators. Basically, these are indicators that people make at home with their own ingredients. And that's where I come in. So I've made my own sentiment indicator, and I'm going to give you the details of that right now. Let's see, number one, as I kind of mentioned, it examines elements of fear and greed in the market, and it uses those elements or factors to calculate the model. It's calculated on a weekly basis. I've been working on this like forever. It uses a proprietary, that's a fancy word, maybe I shouldn't have said that. Basically, I use a moving average in a certain way of measuring the data in order to make the model. And it's been forward tested. This is something that no one does because it takes a long time. I forward tested over 20 years, maybe 25 years. I don't know, something like that. But basically, that means I created it years ago. So I didn't, overfitted it. Because if you notice, a lot of times when people make indicators or anything in statistics, what they do is they make the indicator work perfectly. And then, of course, when it's actually utilized, it doesn't work at all. And that's a problem when you backward test indicators or any type of quantitative / statistical model. I'd like to more rigorously back test it, not because it hasn't been back tested, but because I want to see if I can pinpoint better ways of trading around it. It works better during market tops, that's for sure. During market bottoms than market tops. And it's useful, highly useful for DCA. And it's bullish. The indicator is bullish when it's at a 6 or greater reading and bearish when it's at 4. But of course, there's different regime changes, right? Different regimes, like interest rate regimes, inflation regimes, earnings regimes, whatever. And sometimes during these regimes, it could be bullish at a different level because remember, this indicator goes back many years. And so the regime can make it bullish and bearish at different ranges. I've seen as low, bearish as low as 3. So maybe I could say, I was even thinking about saying, maybe 6 to 3, but there are other times when it was 6 to 4, meaning 4 being bearish. So let's get started. So like I said, I'm going to cover a few of these. The first one is a tech wreck. It gave a bearish signal, and I'm going to put my pointer on it. Maybe I should have put a bubble here. Gave a bearish signal around January of 2000. So it worked pretty well. But one thing I like about it is it also gave a bearish signal on 99. But you know what? It seemed to work. I was going to say it doesn't work too well when the market looks like it's going to go down. But I'm looking at these two cases that actually worked well because I should explain the chart. What it's showing you is the indicator in green versus S&P in purple. And you can see when indicator is bearish, the market's topping. So you saw that in 99. And then again, you saw that this indicator detected the huge historical market top of the bubble in January of 2000. That was only 2 months before the actual top. So that was pretty good. Like one thing I want to talk about is everyone talks about the 210 yield spread is predicting recessions. I have to say, if somebody doesn't predict anything within one or 2 or 3 months, it doesn't have strong predictability. right? You can't say something's predicting a crash or whatever a year before. That's not predicting. So just be careful of that. So in this case, I think it predicted it well. And then one thing I want to note, I noticed this, and only because of so much data, is that it predicted the bottom, the short-term capitulation in September 11, right after the terrorist attacks. It reached an all-time high. But that wasn't a final bottom. So it gave a very strong buy. But then when you have it looks like when you have a long bear market, it doesn't give a big bottom until later on in the bear market. So you could see it actually detected that bottom in October of 2002, the market bottom. But maybe not, because if you look here, it started detecting in July. So what I want to say here, and maybe I didn't say another video, one or two things. Number one, it works well in these historical bear markets, but it seems to give a buy when there's a capitulation. But sometimes, not sometimes, maybe all the times, when you have these long bear markets, you get apathy. And when you get apathy, you don't get capitulation. Apathy comes after capitulation. So then you're going to see a buy at a lower level. That's what I want to say. So you can't say that it was inaccurate maybe when it gave the buy over here in July of 2002, but that was near the bottom anyway, because the bottom was exactly in October of 2002. So let's go to the next slide. And it predicted a short-term bottom during the Bear Stearns. This is the Great Financial Crisis. So it predicted a short-term bottom during 2007. And what you see in the bear markets, you get these up and down movements, right? A bear market is not a V. We only saw that in October 87, which is not here, and we saw that during the COVID-19 crisis. But normally, you don't get that in bear markets. Bear markets tend to be longer, at least a year, and they go up and down, right? And that's what you're seeing with the indicator. The indicator is showing short-term bottoms in the market and short-term tops. So it is working. But what I did say, and I'm going to repeat, in bear markets, you tend to get the capitulations, and here it is with the Lehman crisis. But after the capitulation, you get those longer-term bear markets. So then you get the second buy, and we saw that the stock market bottom in March of 2009. We got the buy right here at a lower level, but we did get a buy. So what you need to do is you just need to know how to read this, and then you'll be in good shape. And let's say you don't know how to read this. Just do dollar cost averaging when this indicator is above 8, for example, and then you won't have problems. You will be okay. And then you can see that it gave a strong signal during the Euro and Greek crisis. That was a big crisis. Remember, Italy was in bad shape and still is in bad shape, and Spain and Greek. I think Greece was restructured or went bankrupt. That's many years ago already, but if I recall, that's what happened. It was a huge restructuring. So let's go on. I said this would be abbreviated. And so it did a good job at giving a strong buy signal when the U.S.'s credit rating was downgraded and during the Brexit vote. Okay, next slide. Oh, that was it. So I should have mentioned in the previous slide, but you can just play it back. It indicates about 6 now, saying that there is a chance that we can get a bull market, a bear market rally, I should say, not bull market, bear market rally, because it's at a level. It's not fully bullish, being at 8 or above, but it's not bearish either, being below 4. We're about 6.5. So it is supportive of a bear market rally. And if you look at other indicators outside of sentiment, such as the put to call ratio, that is supportive of a Santa Claus rally. And when I say Santa Claus rally, I don't mean literally like December 26th, 24th, whatever. I mean going into January. So that's all, folks. I hope you like this video. If you have any questions, please put them in the comments. And if you'd like to see me talk about something else, maybe talk about some blockchain projects. It seems like no one's talking about blockchain projects. People are scared to recommend blockchain projects because crypto is just crashing. So if you have any questions or any thoughts or any feedback, please send it to us and like us, and have a great new year, everyone.